Good Friday morning, Market Chameleon, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, like all our shows, is for informational purposes only concerning Market Chameleon tools and products. With that, good Friday morning, D.
Good morning, Will. Good morning, everyone. Happy holidays. So today we're going to cover implied volatility and historical volatility. And it's coming from it was a question, it was a while ago, but this question comes up sometimes. So what we'll do is just do a quick overview, how to look up an implied volatility for a stock if you're doing research on it, and seeing if we could look at some reference points to get a sense of where the most current implied volatility stands relative to historical benchmarks. So I'm going to share my screen here. And what we'll do is look at a particular stock. And to do that, you could just type the stock symbol up top in the search. I'm going to just use Apple, for example. So when we type in Apple symbol up top, you're going to actually end up on this summary page, and it does give us some actually over here it does give us a chart of the current implied volatility for the day. You do have a chart for historical volatility. However, what we'll do is reference the options chain. So if you go to the left-hand side, you have this menu, and under options, we'll go to options chain. And when we click on it, you will see on the right-hand side, Apple's options chain appear. And let's close this menu to expand our screen. And as we're on this page, you're going to start looking at different option prices, maybe set of strategies to analyze, and you're going to have these different expirations to select from. However, today we're just going to do a quick overview. It's a shortened day, so we'll probably just do a shortened webinar. And we're going to look at this tab over here, implied volatility versus historical volatility. So when you click on it, you get this pop-up. And in this pop-up, you have a table, and it gives us some benchmarks to compare the most current implied volatility versus historical benchmarks. So over here, you'll see the IV30 column. The IV30 column represents the implied volatility of a 30-day constant maturity option. Okay. And to get that, you would have to use some kind of a methodology calculation to create the index, because you don't have a 30-day option that is listed every single day in Apple, right? The only way we'd be able to track an exact 30-day an option with 30 days to maturity is if there was a new 30-day option, 30-day expiring option listed every day. We don't have that. So since we don't have it, we'd have to come up with some methodology to calculate that using the surrounding data, similar to the VIX. So you'd look at the options that straddle 30 days, an expiration that is before and after 30 days. You come up with a weighted formula for the strikes around the at the money, and you come up with this benchmark that you could calculate it and use on a daily basis. So once we create this benchmark, then we could see how this benchmark is changing from day to day, and we could compare it to historical values, right? So today, the last observation was 17.1. So what does that mean in terms of where this value falls in its historical range? Is it on the high end? Is it on the low end? Because when we think of volatility, volatility, it's not like a stock price that just, can appreciate and appreciate, over time and just keep going up and up and up. Like Apple can appreciate because its earnings keep climbing, its business is doing better. So over time it could just continuously kind of go up. The same thing could go all the way down to zero and go bankrupt. But volatility doesn't behave that way. It's usually trades in some sort of range, right? The volatility can't just keep going up and up and up forever. And every stock is different liquidity, different business models, different analysts covering it. So there's some stocks have more clarity, some have less clarity. So given that, we want to analyze the implied volatility and the volatility of this particular stock that we're researching. So when we say Apple implied volatility 17.1, first we defined, what implied volatility we're referencing. We're referencing 30-day constant maturity at the monies. And then let's look at 3 benchmarks to get an idea where this implied volatility level is in reference to those historical benchmarks. So the first one we see is the 52-week average. So if we took the last years of observations, trading days, and we averaged all of them out, what do we get? Well, that's 22. And now we could see quickly that 17.1 relative to 22 is below that average. So right now the implied volatility is below its 52-week average. Okay, so and that only includes trading days. Okay, so we take out the weekends because there's no trading during the weekends. So the weekends we will remove from the average because that will skew the average, right? Because the weekends just would be the same thing as on the previous day's close. So now that we know the average, what about the high and low? Like how are we far away from the lowest level we've seen in the last 52 weeks and the highest level? So we'll take the whatever it is, let's say 252 trading days, and then let's take the lowest implied volatility. So this would be an end of day observation and compare that to the current level. And then we'll take the highest observation compared to that level. And this gives us a sense of the implied, where that implied volatility is on a relative basis. Are we on the high end, low end? Are we near the average? Are we in the middle somewhere? So here's the high, 35.8, and the low is 15.3. So now we could compare that 17.1, and we're near the low end of that 52-week range. Okay. And that just lets us know quickly, or if we pop this open and we are analyzing a particular stock and we're trying to maybe, compare that to Meta or Google or, quickly we could open this, scan with our eyes, and assess where that implied volatility is from a historical level. So now that we have that, we may want to also reference the actual volatility of the stock, because what is implied volatility? It is derived from option prices, and just like the name says, if these, based on the option prices, the markets are implying a certain volatility going forward, right? That's kind of like the market's anticipation of what the volatility will be in the next 30 days. Well, the but that will also be, when you're doing that, we don't know what the actual volatility of the stock will be, right? We know what the markets are anticipating. We don't know what the actual volatility of the stock will be, but we could measure the stock volatility, the historical stock volatility, and also compare that to the the market's implied vol. So here, how do we measure the stock's volatility? And there's no one correct way to do that. There's no one right formula, or there's just different methodologies to doing that as well. And one of the questions, that you may be asking as well, if I'm measuring the volatility, how many days am I using? Because I could measure stocks volatility based on 1 year of data. I could do 1 month of data, 6 months of data. So you could see that there's a methodology to it, and also, how do you treat outliers and so forth. So over here, we have 2 different benchmarks. One is looking at 20 days of historical volatility. So these are 20 trading days. And some of these are just industry standard days. That's why we're using them. 20 days is basically looking at a month's worth of trading days, right? So this 30-day IV is looking at a calendar month, and then it's comparing it to the previous 20 days of historical volatility. So if we looked at Apple and we looked at, 20, the last 20 trading days, and we used, what we're using here is an open, high, low, close historical volatility calculation, this is what we get. So here in the last 20 days, we're seeing 15.9. And this also indicates then to us that even though implied volatility is on the low end of the historical range, it's not below the most recent 20-day observation. The stock has not been moving at a particularly high volatility itself. So maybe that is somewhat justified why implied volatility is coming in. The market's maybe just getting pulled down based on the daily volatility of Apple. Okay. So maybe that implied volatility makes sense. If we expect the volatility of Apple stock to look similar to the most recent 20-day observation, right, then this implied volatility may make sense. Okay, it might not be that crazy that it's so low. What about the historical average volatility in the last 52 weeks of Apple? If we just took 52 weeks of data and then we said, run the 52-week volatility, the realized volatility of the actual stock. And how does that look? Well, here you could see that was 21. So you could see that the implied volatility and the historical volatility are very close. And this is using 20-day moving averages, right? That's what this is looking at, 20-day historical vol. So that's very close. And to observation here is that the last 20 days is below its average, just similar to the implied volatilities, right? That the most recent uh, volatility observation historically. The most recent observation of the implied vol, they're both below its 52-week average. What about the high and low? We could see here the high is 30.5, the low 14.8. So again, the implied vols and historical vols look like they're very similar, doing something very similar. So one more metric we could use is an entire 252 days of data to smooth out those averages. So if we're using 20 days of data in here, we could use entire 252 days to really smooth out the averages to see like what is the longer term volatility in Apple. Okay, because you could have a 20-day period where it's very low. You could have a 20-day period that's very high. So if we just took 252 days of data and use that in our model, what do we get? So here is 21.4, which you could see right now, both the IV30 and the 20-day are below that. We took the average of all those observations, it's 20.4. If we looked at the high, which is 22.9, the low 18.5, you could see that, that historically, with more observations, right, with the high more observations, the current volatility is trading lower, and so is the implied volatility. If we think it's going to revert, let's say our opinion is different than the markets, and we think even though the last 20 days, the markets or Apple have been particularly low, and that the next 20 days are going to look closer to where its longer term averages, and the implied volatility might be then on the low end because it might be look closer to where its longer term averages is, then these implied volatilities would look like they're on the cheaper end, on the lower end. If you believe otherwise, that we're going to still continue to see volatility on the low end because we might be in this seasonality pattern where we're entering in December with holidays and people are more concentrated on other things than trading, then these implied volatilities may be justified. So that would involve a deeper analysis, and then we could go look at the seasonality impacts. However, just for today, I'm going to end here, and I wanted to show this quick pop-up where if you're moving, especially from symbol to symbol, or you want quick reference prices of where is that current implied volatility, and you have it up here, 17.1. You could see it's subdued. You could just pop this window open and get these reference prices while you're on the options chain. Okay, so this allows you to analyze it in here prior to having to go to a bigger chart and more deeper analysis. If you spot something where you think that that's interesting and you want to go and analyze it deeper. So I'm gonna stop it there.
Yeah, that was great, D. Maybe something we can look at on Monday. Mike was asking about, is there a way to look historically how shortened days have reacted in the market? I don't know if we have it's Friday after Thanksgiving. I think most of the short days, but anyways, maybe that we can look at that on Monday. Awesome job, D. Thanks everyone for joining. Thanks for the questions. Thanks for the great webinars, D. I'm thankful for that.